everyone, and welcome to the Gatewood Wealth Solutions weekly market commentary broadcast. This is John Gatewood, and with me today is our Chief Investment Officer, Aaron Tuttle.
John, thanks for having me.
I'm glad you're back again, because this was a pretty exciting week. A lot of exciting things, interesting things going on. In fact, we just lost our Supreme Court Justice,
Yes.
Ruth Bader Ginsburg, and that'll be a hot topic for sure in the weeks coming forward.
All the way up to the election, for sure.
And it's certainly going to have some impact that we're going to talk about today,
Yes,
because
absolutely.
whether or not we get another candidate nominated and on the Supreme Court, that could change the outcome of what happens during the election. And of course, that'll have some impact on the market as well.
I don't think we've had a quiet week this year.
We haven't. This has been a remarkable year. We'll have to go back and look in next year at this time to see how much other stuff came about other than what we've seen so far.
There was one titled market update that we had where weeks where decades happened.
I know.
Certainly.
It has certainly been that way, hasn't it?
I think we're at a millennia now.
Well, let's jump into our timeline and how we're doing in terms of our predictions as to where the market would be.
So our most earliest green is that the industrial activity would be rebounding. Today we'll get into this on the where we are for the economy and GDP. It's the first retraction that we've seen since the bottom on the industrial index. So there is some caution. We've been warning about that caution for some time. We do think ultimately we will get out of this, and we'll put another one more green box on here. But there's certainly been complications to that rebound.
Well, now we also see that the coronavirus cases are starting to tick up, not just here but globally. So how is that impacting governor's decisions and what we expect in terms of opening, lockdowns, and so on?
So far, most of the openings continue to become more liberal, so we are not getting a return or a restriction as we did during the Sun Belt increase. But as you mentioned, there has been an increase here in the U.S., but when we look at it, and I don't think this slide is formatted well for our screen, but most of that uptick is in rural areas where the hotspots are arriving. So far, and we've talked about this before, we are not seeing those hotspots in the big area. We kind of assumed that we would still see a decline. This week has been contrary to that thesis of a continual decline. But most of the uptick in the U.S. has been in the rural areas that really have not had a big infection or hotspot prior.
Well, now we're talking about the second wave, and that's what the European countries are concerned about, and they're starting to see a little bit.
Right. So many of the European countries took a more strict lockdown procedure relative to the U.S., certainly more strict than Sweden, and there was a lot of criticism with the United States. And if you look at that profile, you can see that the U.S. and Brazil, another heavily criticized country within the way that they implemented lockdowns, there was a large surge, and they certainly were experiencing more cases than was in the areas that were more strict. But now that those economies or those regions are becoming more open, there's now a surge. And I think it coincides with another phenomenon that we've talked about on the lower temperature, lower humidity. We mentioned meat packing as an area where a lot of the hotspots started to arrive. And if you think about the temperature right now, it's also aligned with lower temperatures, lower humidity. The thing is, the U.S. has had a large amount of the population relative to the amount of population in the Eurozone that has already had the virus. So there's less people in that susceptible area to be infected. So maybe the U.S. will not have as a large case as the European Union. When we look at it, we're still on a declining trend line while the European Union is going parabolic.
Yeah, well, I think that the issue is what we've talked about before, that it's a seasonal virus, right? So we're not quite in that season yet, but we're starting to get there. So that's going to be the real telltale sign is, have we been able to mitigate that future increase when the true season comes about in the winter and spring because of this hopefully herd immunity, and if there's a vaccine by that
we're
time.
watching Sweden. We've talked about that before. We're certainly not an expert on what is or isn't herd immunity. We're just kind of using logic, and we see that the European Union over to the right, France, United Kingdom, Germany, Italy, all the countries or the dominant or the larger population countries are increasing. Sweden continues to be on that decline.
Well,
so have they achieved that herd immunity? It's yet to be seen. There's theories that the coronavirus, which tends to be actually a later, it's something that we go into the spring for that increase. Are people, because they've had experience with similar viruses, their immune system responding prior, so we don't need these big numbers? There's so much about this virus we don't know, but we will be watching Sweden, because if we see that uptick in Sweden, then you could pretty much rule out that there's any chance of that herd immunity elsewhere if we do see that.
Exactly.
So, we can't prove anything, but we could disprove something for sure.
So some of the news that came out of the CDC this week had to do with the collateral damage, for lack of better terms, of the coronavirus and the lockdowns.
Right.
In other words, that these are other health issues that they've seen an uptick in as a result, at least in coincidental timing with the coronavirus. So let's talk about that.
Well, I would find it very coincidental if it was not related. So there seems to be this indirect notion. We've talked about it before. We went over the slide of just comparing the death rate versus 2018. And you can see in this slide that if you look at the average deaths per different categories and compare it 2015 to 2019, in each of these graphs in March, all of a sudden you see a rise. So people that are not getting their cancer screening, people that are nervous to go into the hospital for heart disease and other factors, we're starting to see that. One thing that we've been watching, it'll take a long time for the data to come out, is how many additional suicides are happening. Not just because of the lockdown and the isolation that will have and play on people's psychology, but also just when you go through recessions and you have high unemployment, that extra stress on people does cause an increase in suicide. So we are seeing that number, and it starts at the exact time that the lockdown.
Oh, I think the interesting thing is that we've talked about this before, but now we have actual data that shows the proof of the collateral damage of all the other deaths as a result of the coronavirus lockdowns and the fact that people have not been able to get their normal health care treatments. So let's move on to the federal government, because they're concerned that their paychecks are going to stop. In fact, they probably are thinking about their own paycheck protection plan the way they did for the other U.S. citizens, but now they're thinking about it for their own selves.
Yes, well, typically what happens if there is a shutdown, that federal employees do not get a paycheck, but they always get paid in arrears once the matter is resolved. So it's kind of a paid vacation. So I don't know that it's the same risk of us non-federal employees, right? But no, we do have an impasse in just Congress trying to pass this bill. We also have an impasse with the fiscal stimulus. So we may be looking at another shutdown. There's also the additional stimulus that President Trump would like to get passed, and we had talked about before where there's $1 trillion for the Senate Republicans as kind of the target, and the House Democrats want $3 trillion. We said if anywhere it's going to meet in the middle, and it met nowhere. We had $0 trillion minus some of the money spent through executive order. But President Trump has said we need to get this through, and it needs to be bigger. So at least the president is saying, let's move closer maybe to that $3 trillion. We've seen $2.2 trillion as a number thrown about. So we'll continue to watch for, one, the shutdown, and two, any additional stimulus.
So one of the big issues that we were talking about at the very beginning is the Supreme Court Justice nominee, and the fact that there are changing trends with regards to this voter registration, mail-in voting, and so on. So we had just yesterday, I believe, there was the appeals court judge in Michigan that upheld this lawsuit that was brought together by the Democrats in terms of allowing the mail-in ballots to be counted for some period of time.
Up to 16 days.
Up to 16 days after the voting date. So what can we expect from this? Because this is going to cause even
There
greater
was also
concern,
in
right?
Pennsylvania, which is certainly going to be a battleground state, or at least assumed to be a battleground state, where it's not 16 days, but it is 3 days. So we are seeing decisions made on the rules on how these mail-in votes are going to be counted. And we're only 45 days out from the election. So we've talked about several times not taking a political team. We're not advocating either one, but that the political risk of not knowing on election night who the next president is there. That's significant, and we just point back to 2000 as an example of how one single state with one hiccup can cause a lot of uncertainty in the system.
Well, that's why the Supreme Court justice nominee could be a real political hot potato, because that could determine potentially what that outcome it would be.
Right. We've talked about the red mirage several times on where the Republicans are more likely to go to the polls and be counted early. It looks like a landslide victory, and then you have these mail-in ballots come in, so it wouldn't be decided. But then let's say that it's not decided and we get a situation like 2000, where it has to go to the Supreme Court. Well, right now, with the passing of Supreme Court Justice Ginsburg, we would have a 4-4 Supreme Court, or possible 4-4 tie, likely also a 4-4 tie. So then, just looking at data, we saw a blog post that had done the math and actually put in, well, what is derivatives, or what are the options and futures saying about the potential risk? And if we look at this bottom right, we can see 2008, 2016 was almost non-existent for political risk being priced in the market. 2012 was a little bit higher, and then 2020 is just off the charts with the amount of political risk that is getting priced in based on the probability on the futures market.
Yeah, I think the important thing is that our long-term trends are positive, but it's certainly predictive of a potential rocky market over the next few months.
And political process.
And political process. So let's talk about political process. How are we doing in the polls?
So we've talked a few weeks ago about a surge for President Trump whenever the riots were taking place and the protests, as well as the RNC. But since we were about 2 weeks past that, the trend line has been in favor of Vice President Biden for the campaign. So he's been on the uptick based on the betting odds. Now, we know that the betting odds missed 2016. They missed Brexit. They're wrong. So take this with a grain of salt. A lot of people like to point to them because at least this is people's money behind it. But they have as good of track record as the polls.
So now we have a new poll that has not been brought up before.
Right. Some anecdotal evidence. We do have an analyst who is fluent in Chinese. He watches the Chinese markets, and it's the Iwu Index, which is basically they're measuring the amount of political paraphernalia that's being sold for the different campaigns. So in 2016, T-shirts and caps for President Trump, or then candidate Trump, significantly outpaced Secretary Clinton or Senator Clinton. And that they say anecdotally that this was evidence that everyone should have known that the election was going to go one way or another. Currently favors President Trump on the amount of paraphernalia being sold. There's probably a lot to that, right? It's all anecdotal because President Trump is having rallies where people are attending. I would assume that he would have more hats and more flags to sell, where Biden has been doing more virtual.
I would certainly think that China would like him to be buying more. In fact, if both candidates were dead heat and they were well ahead of prior years, they'd be happy.
You know, it's just the oddity of the world that we live in, that both candidates are really running on things that are kind of populist. So America first for President Trump, but even concessions by Vice President Biden on trying to put protection and tariffs. Yet both of the campaigns, the way that we go to China to see how the political paraphernalia is being sold, right?
So how's our economy doing?
We did have a dip from the previous week, and it was in areas that have been strong. Housing is slowing for week over week, so that it's still a lot of noise right now, as well as retail sales, capacity utilization, and once again that industrial production index had a little bit of a pullback. Does this mean that it's a new trend and we're going to go down? We're not sure yet, but we are paying attention to the data
Yeah,
and
they
have
did-
been cautious for a little.
They did report in the Wall Street Journal over the weekend about the inventory of homes versus home buyers, that the inventory has shrunk dramatically, and I guess that's one of the reasons why the prices are going up, not just because of the low interest rates, but just because of the inventory. How does that going to play into this new home drop?
Well, let's. We actually have a good slide for that. Let's just run through some unemployment, and then we'll get right there.
Perfect.
So we got a
Let's
couple
do
of
that.
things between there, but let's just unemployment. We've talked about how concerned we are about unemployment and just kind of stalling here, as well as retail sales being down. But then to get to your statement on inventory and housing prices, it really depends on region. And if you look at U-Haul data, which we have up here, if you're moving from Los Angeles to Phoenix, it's really difficult to get a U-Haul truck. You'd pay about $2,000 to rent that truck to move from LA to Phoenix. Going the other way, they're so desperate for trucks in LA that if you were to go from Phoenix to LA, it would only cost you $186. And you can see the ratios where LA and then San Francisco are trading at 10 multiples. So that just shows you where people are moving in inventory. If you want to buy property in San Francisco or in LA and you believe that this movement away from these cities is just short term, you probably could benefit if it is short term, but we have seen decreases in these areas, as well as New York and Chicago. And if we look at what are the most businesses closed, we can see that it's in the areas with the most strict lockdown measures. Now, we're not trying to say causation, because it could be, and this is where statistics gets confusing, is it that they have stricter lockdowns because they had a worse experience with the virus because of population densities and others? Possibly. Is it that they're losing businesses because they are locking down and they didn't have a different experience? Probably a combination of both. But either way, the stricter lockdowns have certainly impacted businesses, and people are leaving those areas just because there isn't employment, and they're going to areas that have not been hit as hard. Now, whether this trend changes.
Well, it's interesting. My daughter lives in Washington, D.C., is looking for a new apartment because she lives downtown by the Capitol. And all of a sudden, inventory has gone up. So there are many more opportunities, and she's finding that there are incentives to come and rent an apartment, to sign a lease, where they'll not charge a lease for the first couple of months. Because a lot of the people that are now work from home, and they're finding that they're moving out of the city because it's less expensive.
Right. There's a lot of things that are at play, and we definitely are going to see changes going forward. One of the things that we did look at with employment, though, is who's being impacted the most. And if you're in the knowledge economy, if you're a lawyer or you're an accountant or you're an architect, that's not where the issues have been showing up. And we all know this, that it's in the retail space, it's in the restaurant space. One of the troubling things, and why we think unemployment has kind of slowed on its recovery, is this bottom left chart. There's a lot of permanent closures of businesses that are starting to happen, and I'm pretty sure we know what areas that they're happening, as well as a drop in the number of small businesses being formed. So we're losing more of these small businesses, and no one's replacing them with additional businesses. So we think that's what's driving the slowdown in unemployment.
How do you think this is going to be impacting the banking industry? Because a lot of these businesses, of course, will have had loans, and so now they're closing. So that means that banks will be settling for pennies on the dollar. What type of an impact do you think that'll have on the financial sector?
Well, one of the things that our listeners are aware of is that we pay a lot of attention to money supply, and one of the ways that money supply can increase is by banks making loans. And there is so much uncertainty in the system that businesses are not opening, and a lot of times you need to borrow to do so. And those loans aren't being made, but also banks are probably reluctant to loan for opening businesses because the uncertainty. And we've talked about this on previous conversations where just lost my thought.
We were talking about banks and the lending, and so banks make money when they lend, but now we have companies that are going out of business. So banks are now having to collect pennies on the dollar for the loans that they have outstanding.
And they're unlikely to make the loans. Not getting back where I was, but.
Well, let's move on.
It's a good point. Maybe we'll put it in comments after.
Yeah, we'll see if we can recall that comment. But so one of the things we have been talking about is commodity prices and how meat prices in particular have gone up through the roof.
Right.
And now it's going in the other direction. What's happening there?
Right, back to the cooler, low humidity environment where the outbreaks were happening in the meat processing plants. It wasn't a shortage of cattle. It wasn't a shortage of pigs or chickens. It was that we couldn't process them quickly. Well, one, if they survived and they were continuing to be fed, they're bigger. So we're seeing larger amounts of meat weight for the cattle that's coming. So that's given us a surplus as that process. But I think there's another phenomena, and I don't think it's really getting reported on whenever we're reading the newspaper, is commodity prices, specifically grain, has been going up substantially. And that's a farmer has to feed the cattle, and the price of grain, it becomes a carry cost, so it becomes more expensive to have larger populations. So they're going to drop that. So if you do have room in a deep freeze, especially with the amount of uncertainty that we've talked about in politics, I know I always feel more comfortable having a full freezer of meat. It's probably a good time.
Well, you're more of a carnivore in terms of your eating habits, so you should definitely go out and buy lots of meat and pack that refrigerator or freezer.
Yeah, my son has told me my superpower is eating, and I agree with him that if I do have a superpower, it is that. But no, it would be probably a good time to take advantage of the lower price of meat, because we don't think this is a long-lasting phenomenon. At some point, the market's going to settle, come to equilibrium, and likely have prices begin to increase, especially considered the inflation risk that we've talked about before.
So the money supply, of course, is one of the key indicators that we look at. And while we had the meteoric rise of the money supply, now we're having a precipitous drop.
Yes.
And we know that can have an impact in terms of capital asset pricing. So where do we see that right now?
We continue to see a decline in money supply. That's why we have been becoming more defensive in portfolios, rotating out of some of the things that have done really well, technology, towards long short. We added commodities that have been doing fairly well, as well as raised up to 36 months of cash for those that are nearing retirement. We don't see this as a long-term issue, but we definitely see volatility here in the near term. And probably some more downward movement in the market. Timing these things is very difficult, so what we try to do is just adjust the risk in the portfolio. But we continue to see a significant decline, back again to the banks not loaning out money because of uncertainty, fiscal stimulus not being passed, and then just businesses really slowing because of all the uncertainty in the system. So we do expect the money supply to continue to have its downward tick. If we do see a recovery in that, we may be reaching out to those clients that have set 36 months aside. If the market is fairly cheap and we start to see positive signs again, maybe we put some of that cash back in. But so far, the timing has been good, but it wasn't a necessary call. It was just based off process and looking at the data.
Yes. So I know that we filled the cash hubs, and now we saw the volatility of the S&P 500 and the other market indices. Where are we now? Especially because if you look at the money supply declining, we did see some price decline in the markets this week. What do we see going forward?
So the market has certainly had a significant rally out of its March low. And we did break that trend line last week. We bounced off of it and then finally did break it. I think on Wednesday, while we were doing this call, I think that's the time that around the time that it dropped, and we'd warned that if it broke that trend line, we would see some downward action. That happened. We are starting to see a rotation back to those coronavirus stocks. So some of the things that we have dampened are actually holding up well in the portfolios. But if we just look at technicals, one, we see a support probably somewhere between 3250 and 3000, and support at 3060, 3050 based on technical retracements. And at some point, the Fed will probably begin to jawbone. They have not done, or at least the market has not considered them being very accommodative relative to this recent pullback. So that's some of the uncertainty in the market as well. This is normal. It's healthy. We want to see movement like this. It certainly is going to cause concern with everyone, especially whenever we look back to the February 20th high and how fast it dropped. We're watching the money supply. We still have a lot of money in the system, and there's a lot of money on the sidelines. So it's not just the creation. On these sharp sell-offs, we're probably going to have relief rallies as people begin to deploy that cash as prices go back down. Ultimately, though, without inflation, the Fed feels they can act and become accommodative and support the market. We're actually seeing that in their policy as starting to adjust the way that it's not just unemployment and inflation. They're talking about the way that the market is behaving, which we think is dangerous because markets are supposed to be price discovery. If the Fed's stepping in based on the market trying to discover prices, that's causing more noise and more problems. And we've warned against that, but they don't tune in and listen to us. So.
Well, maybe they will if they subscribe to us, and we can find somebody to subscribe from the federal government. But one of the things you're talking about is the fact there's a lot of money on the sidelines, and I was reading about how the banks have now increased the amount of treasuries that they're holding because they can't loan out as much money as what they were hoping to. And what will that mean in terms of market volatility going forward?
Well, ultimately, that's considered Tier 1 capital, and banks can lend on that collateral and expand the balance sheet. But I don't think they're going to do that, and nor are people going to be going for a lot of loans until there's some more certainty with what's happening in the economy, what's happening politically. So we're just in a waiting period at the moment.
So let's talk about the dollar, because that's another area of concern that we've been watching, because we did have the drop. How is it right now?
It's still relatively high based on the last 10, 15 years, but it has been moving down. It did bounce off some support, and we're getting a relief rally here. We do think with the amount of money that the U.S. has created relative to other central banks, we're probably moving into a declining dollar environment, and ultimately we think that will help small and mid-cap companies, help some of the labor price differentials between the U.S. and other areas. That comes at a cost. We've talked about that, a lower standard of living, or at least a higher cost of living if the dollar's dropping, because so many imports do come in to the U.S., meaning if our dollar doesn't go as far, it's more difficult to buy the amount of goods that we're buying.
So one of the things that we've talked about is the fact that the increase in the money supply is inflationary.
Yes.
But you have the relevant values or relative values between the various countries. But since all countries now follow this central banking system of artificial money supply, how will that play out in the future with regards to looking at the value of the dollar relative to foreign currencies if they're all able to debase their own currencies?
Well, it's a race to the bottom. And comparing the U.S. dollar on how it's doing to other currencies is really not a great comparison because it's comparing a weak person to other weak people, right? To really understand what is the true strength, let's look at a very strong thing, and that's what people do whenever they're looking at gold. So if you look at the price of the dollar versus other currencies, yes, it's dropped, but it's not dropped nearly as much as it has dropped versus precious metals. And I think the precious metals is that store of value that people look at historically whenever fiat currencies begin to be abused, because every country or every economic zone that under a currency is trying to play the same game, which is to lower their currency value to try to pick up market share by basically making their labor cheaper on global markets, but they're all playing that same game. So we've seen that rise in precious metals. We've also seen new technology with with Bitcoin coming on as an alternative, and it has also done well. We do not think that Bitcoin will be the next safe haven currency. We could certainly be wrong on that. There are plenty of people in that technology currency or that cryptocurrency world that thinks that it will, but it has certainly gained from the other the governmental currencies versus these technology and the historical currencies.
It'd have to have a much bigger network effect, as we talked about with companies like Google and Amazon, or the more people that you have that are using that currency, the more valuable that currency would actually become. But as
currencies are ultimately based on trust, and
Yes.
trust in holding value and that be accepted. So you can violate that trust. One of the ways that you can do that is print too much of it, and you can also, with Bitcoin, if people become they trust it that it'll continue to be accepted by other people. That's ultimately how money or paper currency. It's all digital currency pretty much anymore as well. It's all a perception of trust on how it gets its value.
So let's move to our relative strength chart. How have the different asset classes done relative to the S&P 500 and each other this week?
So we continue to see a lot of movement on this graph. We tend to catch trends, and we're in that period of time where there really hasn't been an established trend coming out of this. Kind of the kaleidoscope is changing. We just don't know what the pattern's going to look like whenever it finally settles. Commodities is still near the top from last week. We do have some small exposure to a broad basket of commodities as well as gold miners. Gold has now risen. The green means that it's rising or it's on the uptick. Yellow means it's starting to slow down. So we can see commodities as a basket are slowing down while gold is rising. International is also picking up some relative strength. Technology still is doing better than the S&P 500, but Amazon and NASDAQ certainly have had a rough few weeks. This week's been pretty positive for them, as mentioned earlier, but we still do see a weakening over that 2 to 3 week period. It's certainly not like it was in February, March, when those COVID stocks were basically defying gravity relative to the indexes.
Let's talk about another topic. We have a new exchange that's coming out to the market that's going to compete with the NASDAQ and the New York Stock Exchange that's going to be less expensive. How does something like that even get implemented into the market?
Well, it's certainly, times have changed over the last couple of decades. The amount of trade costs has gone from $200 to trade to just pennies for the trade. So I don't think it's going to be a big impact on the market because a lot of it has been, the term they use is democratized, where a lot of people are able to play and act as exchanges. So I don't think it's going to have a big impact because a lot of the monopoly powers that, let's say, the New York Stock Exchange, or privileges, not powers, that they had previously have already been pulled out of the system. So will this exchange be cheaper? Will it pick things up? Yeah, probably, but then the profit margin is not what it used to be at $200 a trade. So capital is scarce. It's going to be competing. I don't see it making a big impact on the market because it's a pretty efficient market as well. If someone can do it better and cheaper, great, we'll move to that. Bitcoin, whether it's a currency or not, I think the technology behind it on how it transfers, you have an intermediary, the exchange is basically transferring that title of ownership of something. Bitcoin does it without any institution behind it. So at some point, that ledger system will probably be applied to markets, and there won't really be a physical exchange or a corporation that's doing the exchange. It'll be embedded in the system, and it'll probably be nearly free, other than the cost of energy to make the transactions happen. So all of that is pretty sci-fi and further out, but that is the trend, and continuing to see a decrease in price on trading in an exchange, a more efficient market seems to be happening. It'll be interesting to see how the private markets, which have become a very big, deep pool of liquidity, will deal, because the public markets have a lot of constraints based on regulation with the amount of capital and the ease of the ability to clear these trades. So
Right. I think that's one of the things that we've talked about that's going to become a larger and larger component of wealth is going to be private securities because of the fact that there is so much money in the system. Technology has enabled the information about those companies to be much more readily available. And oftentimes you find that the information is actually easier to decipher.
Yes.
And more accurate because you're not talking about these mammoth companies like an Amazon or a Google.
One example is we have the Wilshire 5000 Index, which was the 5,000 biggest companies at one point. We don't have 5,000 publicly traded companies now, so we probably need to rename the thing to, I don't know how many ever companies it is, probably in the 3,000s. So a lot of companies are not going to public markets because of these deep pools in private market. There are still new companies being created. They usually just don't make it into the public sphere until much later. An example would be Uber or Facebook, Lyft, where they are already developed fairly mature large companies before they ever make it to the public market.
So another thing that we saw happening was with COVID, initially was the disruption of the supply chain, and we were seeing more of a protectionism because we were trying to prevent jobs and markets being taken away from us, and there's kind of a global effect. However, global trade has returned faster than it did in 2008 when we had the big drop then, which seems to be kind of reversing that trend somewhat. Can you comment on that?
Well, I think that there will still be an examination of how your supply chain is developed and how far across the globe it spans. And we're already seeing companies in Germany start to create and carve out different regions and basically put the supply chain for that region in that area. There's a lot of onshoring that we think will happen going forward. So we do think that those supply chains are going to become shorter. Especially if you start thinking about like daily delivery or same-day delivery in Amazon, that's going to require supply chains to be there. And if we get automation where labor costs are really not as impactful to the cost, and transportation costs become more of the factor or more of the cost to bring things to market, it seems that it would be logical that you would have smaller footprints and just more of them. Ultimately, I think that makes a stronger system, especially if you can keep the costs of that system lower. But we're definitely in a new world than we were prior to March.
So one of the things I'm concerned about is the convergence of all these different factors that are going on right now. I mean, number one, you have a rapidly declining money supply, right, which we know impacts the capital asset pricing of the stock market. You have the uncertainty of the election, and now a greater likelihood of even a protracted time period by which we'll even know who's going to be the ultimate winner. You have the lack of movement on the part of Congress to provide another stimulus, which is also going to, I think, have some type of impact.
Sure.
You have COVID now with the potential of coming on for a second wave resurgence, and then the governor's reactions to that. Are we facing a potential to have another March effect where we had a precipitous, dramatic drop in the market over these next few months? And what should investors be doing right now?
I don't think you can rule out that scenario, and just listing that thing, maybe we need to make a new timeline, right, for the beginning of the call as you go over those, because there are a lot of moving parts at the moment. But our process helped us weather that storm in February and March, and we did better than the benchmark on the way down. We did better on the benchmark on the way up. Could we have stepped out on February 20th at the high and bought at the very bottom? I guess it's theoretically possible, but we don't think that we have.
If we have a time machine that will allow us to go backwards, we'll solve that problem.
Except that we're a Chaos 2 system, so the moment you have that, the system would change anyways. But our process has done well this year, and we do not expect or anticipate excess returns in the plus 20% relative to the benchmark. If they're going to happen, though, they're going to happen in these very stressful, calamitous times. We just went through that, and it did well. So we would just continue to look at our process and remember these crises really create opportunities. And if you can help push those emotions down and not act like the rest of the market and trade just out of fear, but keep a level head, whether it turns out where you time things perfectly or not, that'll never be possible, so don't make that a goal. I think it's reasonable to say that there's going to be opportunity there, and looking at it and taking advantage of it would be crucial, and what we plan on doing if those things were to materialize.
Well, that gives us great confidence to know that we do have a system that actually works well with change, and I think that's what our listeners and our clients really want is want confidence to know that we actually are looking at their portfolios every day, because that does matter. Mm-hmm. You know, we're not just setting it and forgetting it. So, well, I think that's all the time that we have today, Aaron. I think that was a great conversation. I appreciate all of our listeners listening in. I look forward to having us here again next week, and we've got a lot of interesting things that will be happening over the next 7 days that we'll be able to comment on.
Yes. And what if listeners would want to speak with their lead advisor, or maybe they are not clients and they would want our opinion? How would they get a hold of us, Sean?
Yeah, well, the best thing to do, first of all, would be to pick up the phone and call us directly, and we'll be happy to speak with anyone who'd be interested in having their portfolios or their financial plans reviewed. We do this on a totally complimentary basis because we feel that we are here to help, and if it makes sense that we can help them, we'll be happy to engage. So the other thing is we have a YouTube channel.
Yes.
And one of the things is we want to increase our subscriptions. How do we do that?
Well, if somebody is watching us on YouTube at the moment, then they would just click on subscribe, and they'll get an alert as these updates are put out there. And if they're just tuning in for the live, take a moment, go out to YouTube, look up Gatewood Wealth Solutions, and subscribe. You never know when you're going to miss it, and we've been doing a lot of work. We actually have a pretty sizable backlog now of these updates, so you can actually go back and look and see how we've done, as well as just how much Jess has really helped us on making a much higher quality
well, we
update.
should definitely give a shout out to Jess Porter, who is our media director guru, who's been able to put all these things together and make us better and better. So thank you, Jess. I know you're out there somewhere listening, so we want to give you a shout out. So thanks again for listening in today. We look forward to having everybody again here next week. So long for now.